Welcome, future wealth builders, to the Millionaires Mentor channel. Today, we're diving deep into the electrifying world of stocks, poised for potentially explosive growth. We're looking for those hidden gems, those market disruptors, the stocks that could potentially skyrocket. Now, let's be clear. Investing always involves risk. There are no guarantees. What we're doing here is identifying companies with compelling stories, strong fundamentals, and significant growth runways. These are opportunities based on rigorous analysis of current trends and future potential, but you must do your own homework. Think of this as a starting point, catalyst for your own investigation into building lasting wealth. Before we name names, let's set the stage. What's happening in the broader market right now in early 2025? We're still navigating the complex currents of artificial intelligence adoption, which continues to reshape industries at an unprecedented pace. Inflation seems to be moderating in many major economies, leading to discussions about potential interest rate stability or even cuts. However, geopolitical tensions and supply chain adjustments remain factors that investors need to watch closely. We're seeing a continued focus on technological innovation, particularly in semiconductors, cloud computing, cybersecurity. The energy transition towards renewables also presents significant long-term investment themes. Against this backdrop, how do we identify stocks with skyrocketing potential? Our criteria focus on several key areas. First, a large and growing total addressable market, or TAM. We want companies operating in sectors with massive expansion potential. Second, a strong competitive advantage or moat. What protects the company from competitors? Is it technology, brand, network effects, or patents? Third, proven execution and visionary leadership. Does the management team have a track record of success and a clear vision for the future? Fourth, strong financial performance and growth metrics. We're looking for robust revenue growth, ideally accelerating, and a path towards strong profitability. Fifth, identifiable catalysts. Are there upcoming product launches, market expansions, or industry shifts that could propel the stock higher? And finally, while valuation matters for high-growth stocks, we focus more on the potential trajectory than traditional value metrics. We're looking for companies that can grow into their valuations and beyond. So, let's get to our first pick. It's a name synonymous with the AI revolution, a powerhouse that has redefined high-performance computing, NVIDIA. Now, you might say NVIDIA, skyrocketing, hasn't it already done that? And yes, its performance has been stellar, but the argument here is that the AI transformation is still in its relatively early innings, and NVIDIA is at the epicenter. NVIDIA designs graphics processing units, GPUs, originally for gaming, but now indispensable for training and running complex AI models. Their CUDA software platform creates a powerful ecosystem, locking developers in and making it difficult for competitors to catch up quickly. The demand for their data center GPUs like the H100, Bone 100, and their successors has been astronomical, driven by cloud providers and enterprises building AI infrastructure. Think about every major tech company racing to build generative AI capabilities. They largely rely on NVIDIA hardware. This isn't just about large language models. It's about AI and drug discovery, autonomous driving, scientific research, and countless other fields. NVIDIA's TAM is constantly expanding as new AI applications emerge. They are not just selling chips, they are selling entire systems, software, and networking solutions like Mellanox. Their moat is incredibly strong due to the performance lead of their chips and the stickiness of their CUDA platform. While competitors like AMD and Intel are making strides, and custom silicon from cloud giants is emerging, NVIDIA's relentless innovation cycle and deep integration keep them significantly ahead in the highest performance segments. Financially, the company has delivered truly staggering growth in revenue and profits over the past couple of years. Quarter after quarter, they have beaten expectations, driven primarily by the insatiable demand from data centers. Catalysts include the rollout of next-generation chip architectures, further penetration into automotive AI NVIDIA Drive, and the expansion of their software and subscription services, like NVIDIA AI Enterprise. What are the risks? Valuation is always a concern after such a run-up. Any slowdown in AI spending could impact growth expectations. Competition will inevitably intensify, and geopolitical risks related to chip manufacturing cannot be ignored. However, the sheer scale of the AI transformation suggests that NVIDIA, as the primary enabler, still has a long runway for growth. They are not just a hardware company. They are building the foundational platform for the next era of computing. For investors believing in the long-term AI trend, NVIDIA remains a core holding with potential for further significant appreciation. Consider its role as the picks and shovels play in the AI gold rush. Moving on to our second pick, let's shift focus to a critical sector that underpins the entire digital economy: cybersecurity. In this space, one company stands out for its modern approach and rapid growth: CrowdStrike. CrowdStrike is a leader in cloud-native endpoint security. What does that mean? Let's break it down. Endpoints are devices like laptops, servers, smartphones, and IoT devices that connect to a network. Securing them is paramount. Traditional antivirus software often relies on known malware signatures, which is insufficient against sophisticated, novel attacks. CrowdStrike's Falcon platform was built from the ground up in the cloud. It uses artificial intelligence and behavioral analysis to detect and prevent threats in real time, even unknown ones. Their threat graph collects trillions of security signals per week, constantly learning and improving its detection capabilities. Why is CrowdStrike poised for potential skyrocketing growth? Several reasons. First, the threat landscape is constantly worsening. Cyber attacks are becoming more frequent, sophisticated, and costly for businesses. Ransomware, state-sponsored attacks, and data breaches are regular headlines, driving organizations to invest heavily in robust security. Second, the shift to cloud computing and remote work has expanded the attack surface, making traditional perimeter security less effective. CrowdStrike's cloud-native architecture is perfectly suited for this modern distributed IT environment. Third, CrowdStrike operates on a software-as-a-service (SaaS) model, generating high-margin recurring revenue. This provides predictable cash flow and scalability. They have a successful land and expand strategy. Customers typically start with core endpoint protection modules and then add more services over time, like identity protection, cloud security, threat intelligence, and managed services. This drives up the annual recurring revenue (ARR). Financially, CrowdStrike has consistently delivered impressive revenue growth, often exceeding 30–40% year-over-year, even as it scales. They are also demonstrating operating leverage with improving profitability and free cash flow margins. Their dollar-based net retention rate (DBNR) is typically well above 100%, indicating existing customers spend more over time. Catalysts include continued market share gains from legacy vendors, expansion into adjacent security markets like SIEM and data protection, and potential benefits from increasing cybersecurity regulation and compliance requirements globally. What about the risks? Cybersecurity is a highly competitive field. Palo Alto Networks, SentinelOne, Microsoft, and others are formidable rivals. CrowdStrike needs to keep innovating to maintain its edge. Like many high-growth tech stocks, its valuation is often rich, making it sensitive to changes in interest rates or market sentiment. A major security breach affecting their own platform, while unlikely given their expertise, would be damaging. However, the secular tailwinds for cybersecurity are undeniable. As the world becomes more digital, the need for best-in-class protection like CrowdStrike's only grows. Their platform approach, AI leadership, and strong execution make them a compelling candidate for continued high growth. Let's pivot now to a different region and sector. Our third potential skyrocket is Mercado Libre, often called the Amazon and PayPal of Latin America. Mercado Libre, the largest e-commerce marketplace in Latin America, connecting millions of buyers and sellers. But it's much more than just e-commerce. Its integrated fintech arm, Mercado Pago, offers a wide range of digital payment and financial services. This includes online payments, mobile wallets, QR code payments, credit lines for consumers and merchants, and even asset management. They also have Mercado Envios Logistics, Mercado Crédito Credit, and Mercado Shops tools for businesses. The investment thesis for Mercado Libre rests on several powerful pillars. First, Latin America has a large, young, and increasingly online population. Internet penetration and smartphone adoption are rising rapidly. However, e-commerce and digital payments penetration still lag significantly behind regions like North America or Asia, presenting a huge runway for growth. Second, Mercado Libre has built a powerful ecosystem with strong network effects. More buyers attract more sellers and vice versa. The integration of Mercado Pago within the marketplace and its growing acceptance off-platform create a flywheel effect, driving adoption of both commerce and fintech services. Third, Mercado Pago is effectively banking the unbanked and underbanked population in Latin America, offering accessible financial tools. This addresses a major structural need in the region and represents a massive opportunity beyond just facilitating marketplace transactions. Financially, Mercado Libre has demonstrated impressive growth across both its commerce, gross merchandise volume, GMVs, and fintech total payment volume, TPV segments. Revenue growth has been consistently strong, often exceeding 40–50% on a currency-neutral basis, showcasing the underlying momentum. Profitability has also improved significantly as the business scales and benefits from operational efficiencies, particularly in logistics. Catalysts include the continued secular shift towards online shopping and digital payments in Latin America, expansion of their credit offerings, growth in their advertising business, and further build-out of their logistics network, Mercado Envios, which enhances the customer experience. What are the risks? Operating in Latin America brings inherent macroeconomic and political volatility. Currency fluctuations can significantly impact reported results. Inflation and interest rates in key markets like Brazil and Mexico are important factors. Competition is increasing from global players like Amazon and Shopee Limited, as well as local fintech startups. Regulatory changes, particularly in the financial services sector, could also pose challenges. Despite these risks, Mercado Libre's dominant market position, integrated ecosystem, and exposure to powerful long-term growth trends make it a compelling investment for those seeking exposure to Latin America's digital transformation. Its ability to blend e-commerce and fintech creates a unique and powerful growth engine for the future. Our fourth pick takes us into the dynamic and ever-important world of healthcare, specifically pharmaceuticals. We're looking at a company that has captured significant attention for its breakthroughs in metabolic diseases, Eli Lilly. Eli Lilly is a global pharmaceutical giant with a long history, but its recent surge is largely attributed to its innovative treatments, particularly Mounjaro tirzepatide for type 2 diabetes and Zepbound, also tirzepatide for chronic weight management. These drugs belong to a class called GLP-1 receptor agonists, which have shown remarkable efficacy in controlling blood sugar and inducing weight loss. The potential market for effective obesity treatments is colossal, given the global epidemic. Obesity is linked to numerous other health problems, including heart disease, diabetes, and certain cancers. Eli Lilly's tirzepatide, with its dual agonist mechanism acting on both GLP-1 and GIP receptors, has demonstrated superior weight loss results in clinical trials compared to some competitors, positioning it strongly. But Eli Lilly is not just a one-trick pony focused on weight loss and diabetes. They have a robust pipeline across several therapeutic areas, including oncology cancer treatments like Verzenio, immunology drugs for autoimmune diseases, and neuroscience. Their experimental Alzheimer's drug, donanemab, has shown promise in slowing cognitive decline, although it faces regulatory scrutiny. The investment case for Eli Lilly hinges on the massive commercial success of Mounjaro Zepbound, coupled with continued growth from other established drugs and the potential of its late-stage pipeline. Financially, the company has experienced explosive revenue growth driven primarily by the GLP-1 franchise. This has propelled its stock price significantly higher. Profit margins are expanding as sales ramp up. Catalysts include potential label expansions for tirzepatide into other indications like sleep apnea or kidney disease, positive data readouts from ongoing clinical trials for pipeline candidates, particularly in oncology and Alzheimer's, and increasing insurance coverage and patient access for their weight loss medications, which is still a developing area. What are the risks? The pharmaceutical industry faces constant pressure regarding drug pricing and reimbursement. Competition in the lucrative weight loss market is fierce, primarily from Novo Nordisk, maker of Ozempic and Wegovy, and other companies are developing rival drugs. Clinical trial failures or unexpected side effects for pipeline drugs could negatively impact sentiment. Longer-term patent expirations on key drugs are always a factor for established pharmaceutical companies. Valuation is also elevated after the strong run, reflecting high expectations for future growth. However, the sheer size of the markets Eli Lilly is targeting, particularly obesity, and the strength of its current portfolio and pipeline, suggests that the company could continue to deliver substantial growth for years to come. It represents a bet on continued innovation and dominance in treating major chronic diseases. For our fifth and final pick, let's revisit the theme of critical infrastructure supporting the digital age, but from a different angle than semiconductors. We're looking at Vertiv Holdings. Vertiv might not be a household name like Nvidia, but it plays an essential behind-the-scenes role in keeping data centers running. They design, manufacture, and service critical digital infrastructure technologies primarily focused on power management, cooling. Think uninterruptible power supplies UPS, power distribution units, PDUs, precision cooling systems, and integrated rack solutions for data centers. Why is Vertiv a potential skyrocketing stock? It's a direct beneficiary of the massive build-out of data center capacity, driven significantly by the demands of artificial intelligence workloads, cloud computing, and general digitalization. AI servers, packed with powerful GPU like NVIDIA's, consume enormous amounts of power and generate immense heat compared to traditional servers. This requires more sophisticated and higher capacity power delivery and, crucially, advanced cooling solutions. Vertiv is a leader in these areas, particularly in liquid cooling technologies, which are becoming increasingly necessary for densely packed AI racks. The investment thesis is straightforward. As data center construction booms to support AI, Vertiv's products are essential. They are a key enabler of the AI infrastructure build-out, capturing value further down the supply chain from the chip makers. Their established relationships with major cloud providers and data center operators give them a significant advantage. Vertiv also has a substantial service business, providing maintenance and support, which generates recurring revenue. Financially, Vertiv has seen a strong acceleration in orders and revenue growth, directly correlated with the AI-driven demand surge. Management has successfully improved operational execution and profitability after some earlier challenges following its return to the public market. Margin expansion has been a key focus, and the company is benefiting from increased scale and pricing power. Catalysts include continued strong demand for data center construction, the increasing power density of AI hardware requiring advanced cooling, potential infrastructure upgrades for edge computing deployments, and market share gains against competitors. What are the risks? Vertiv's business is tied to capital spending cycles in the data center industry. Any significant slowdown in data center build-outs could impact demand for their products. Supply chain disruptions could affect their ability to deliver products on time and impact margins. Competition exists from established players like Schneider Electric and Eaton, as well as smaller specialized firms. Execution risk on large projects and managing costs are also important factors for investors to monitor. However, Vertiv's strategic positioning as a critical supplier for the AI revolution makes it a compelling infrastructure play. If you believe the demand for data center power and cooling will continue to soar, Vertiv stands to benefit significantly. So there you have it. 5 companies operating in diverse, high-growth sectors: NVIDIA, CrowdStrike, Mercado Libre, Eli Lilly, and Vertiv Holdings. Each presents a unique investment thesis grounded in powerful secular trends, but identifying potential winners is only part of the equation. Responsible investing requires more. It's absolutely crucial to talk about diversification and risk management. Never put all your eggs in one basket. Even the most promising company can face unforeseen challenges. Diversifying across different stocks, sectors, and even asset classes like bonds or real estate, depending on your goals, helps mitigate risk. Consider position sizing. Don't allocate too much of your portfolio to any single high-growth stock, especially those with higher valuations, as they can be more volatile. Understand your own risk tolerance. Are you comfortable with potential sharp downturns in pursuit of higher returns? Or do you prefer a smoother, albeit potentially slower, path? Align your investments accordingly. Avoid the fear of missing out or FOMO. Just because a stock has run up doesn't mean you should blindly chase it. Do your research, understand the business, assess the valuation, and make an informed decision. Furthermore, adopt a long-term perspective. True wealth building in the stock market is usually a marathon, not a sprint. Companies like the ones we discussed need time to execute their strategies and capitalize on their market opportunities. There will be volatility along the way. Market sentiment shifts, economic conditions change, and stock prices fluctuate. Having the conviction based on your research and the patience to hold through downturns is often key to capturing long-term gains. Think in terms of years, even decades rather than days or weeks, especially when investing in growth-oriented companies. Let's quickly recap the key themes and why these stocks are compelling potential opportunities in the current environment. NVIDIA, the undisputed leader enabling the AI revolution through its hardware and software ecosystem. CrowdStrike, a cloud-native cybersecurity powerhouse capitalizing on the escalating need for advanced threat protection. Mercado Libre, dominating e-commerce and fintech in the rapidly growing, underpenetrated Latin American market. Eli Lilly, a pharmaceutical innovator leading the charge in potentially massive markets like obesity, with a strong, broader pipeline. Vertiv Holdings, providing the critical power and cooling infrastructure essential for the AI-driven data center boom. Each of these companies operates at the intersection of major technological or societal shifts, offering significant growth potential. However, and I cannot stress this enough, this is not investment advice. This is analysis and perspective. Use this information as a springboard for your own due diligence. Read annual reports, listen to earnings calls, understand the competitive landscape, analyze the financials, and consider the risks involved. Consult with a qualified financial advisor who understands your personal financial situation and goals. The journey to becoming a successful investor involves continuous learning, critical thinking, and discipline. Thank you for joining the Millionaires Mentor today. We hope this deep dive has provided valuable insights. Remember to invest wisely, stay informed, and focus on your long-term financial objectives. Until next time.